Hello and welcome to Business Today. I'm Aabha Bakaya, along with me, Siddharth Zarabi, Group Editor, Business Today, and we're in conversation with Sunil Singhania of Abakkus Asset Management. This is our Diwali Samvat special, and we're looking forward to getting Sunil's assessment on the year gone by and strategies for the year ahead.
Absolutely, Abha, and a very warm welcome to you, Sunil, on this show. The past somewhat has been a bit of a challenging year as far as the benchmarks are concerned and returns, and we've seen several factors influence market behavior as well as investors' perception. How would you summarize the year gone by, and what lessons do you think it holds out for the coming somewhat?
Happy Diwali, Siddharth. Happy Diwali, Abha, and happy Diwali to all the viewers who have taken time to hear us. Obviously, as you rightly said, last 1 year has been a sort of challenging year. Uh, we have not seen too many, I would say positive news flow, and it's getting reflected in the returns also, I think, which have been almost flat from a 1 year perspective. And after a long time, I would say Indian markets have underperformed some of the global peers. There's also some of the other asset classes which are right now in a lot of favor, which is gold, silver, etc. But actually, if you see and you go back a little bit, I think last 2020 to 24 was a great period. And when you have a good time, I think people do get carried away, investors do get carried away, and somewhere in the mid 24, markets had started to get a little bit, I would say, overvalued. And it coincided with the election time, and during election time, ordinarily or naturally, the economy sort of slows down because you have the code of conduct, so no new projects get launched. Politicians, government are all busy with the elections, and I think that is what we saw September 24 onwards when the economy and the corporate profits slowed down. Particularly September 24 was a really bad quarter where corporate profit grew only 3%. It also coincided with a lot of uncertainty in the world. We have had multiple small wars, including two wars between Israel and Iran. We have had Lebanon, Syria issues, Hamas issues, small conflicts in Thailand, Cambodia, Azerbaijan, Armenia, and of course, closer home, India and Pakistan. And therefore, there has been a lot of risk on risk off. Currency movements have been all over the place. And one reason why sort of safe havens like gold, silver, bitcoins have been doing well is because dollars movements have been like crazy. From 97, 98, the dollar index rose to 110 and then fell sharply to 96, 97. And last but not the least, the tariff thing has been an overhang since January, which has been almost 9 months. And particularly for India, 25% tariff itself was bad, and then we were slapped with another 25%. So as we speak, we are among the two countries only which have a 50% tariff. And I think amidst all this, markets have seen, I would say, bouts of optimism as well as nervousness. Foreign flows have moved out of India and to other, obviously, markets which have done well, at least temporarily. And I would say is that in all this, having a flat kind of a market is not a bad outcome after 4 great years. But there is a silver lining. I think both the Central Bank of India, which is Reserve Bank, and the government are now very, very clearly, pushing for growth. RBI has infused more than 10 lakh crores of liquidity into the system. The stance has changed from conservativeness to pushing loan growth, and as a result, growth in the economy. The government has also gone on an overdrive. We had 1 lakh crores of income tax benefits and now 1 lakh crore of GST benefits. Obviously, this rate cut of 100 basis point would mean that EMIs would lower, and to that extent, 30, 40,000 crores of additional funds in the hands of crores of Indians. So it's almost a 2.5 lakh crores of fiscal stimulus. So I would say a lot of these headwinds have converted into tailwinds, and we are already seeing signs of growth coming up. Monsoons have been great, so rural economy is thriving. I think it's all about just getting this tariff thing behind our back, and we should start to look at the markets with a lot of optimism.
Sunil, Abacus has always championed growth at reasonable valuations. You've always talked about reasonable valuations. So, what's reasonable in today's market when even quality stocks are, fairly richly valued? And I'd go further to even break up the large caps versus small caps. Small caps, of course, had a good run up, then a massive correction. So, when we're talking about value, are we also looking at a particular part of the market?
No, I think by nature and by our philosophy, we tend to focus on reasonable ROC companies, profit growth companies, and profitable companies. And obviously, we look at investment as if we are becoming partner in the business. So we'll want to become a partner in the business where the growth, outlook is, I would say, combined with the valuations. So where there is growth, we don't mind paying a higher valuation, but where there is no growth, obviously, or low growth, high multiples don't justify. And our stance has thankfully come out pretty right last 5, 6 years. So since 2019, we have been saying that there is a bubble in quality, and the best companies are not necessarily the best stock because they're priced to perfection. So I think there is one bucket in the market which has underperformed massively, but which still continues to be quite overvalued because growth is being sort of evasive for these companies. On the other hand, there are companies and there are stocks where you are seeing valuations not as cheap as they were 2, 3 years back, but pretty reasonable given the outlook we have from the future perspective. And I think that is where we are focusing on. So lot of I think effort goes into meeting a lot of companies, researching a lot of stocks. Luckily for us, India is a large country. We have 6,000 listed companies, 2,500 traded regularly. So many new companies getting listed, and we have a presence across sectors. So it's going to be more a bottoms up stock picking kind of a market, and we are prepared for that. In terms of large cap, mid cap, small cap, I think this debate keeps on going up. From our perspective, as I said, we look at investment as if you're becoming partner in the business. And as long as the underlying investee company, whether it is large, mid, or small, satisfies our criteria of decent ROC, good growth, and reasonable valuations, we don't mind investing irrespective of the size of the company.
We are talking at a time when it seems the rupees 10,000 crore IPO jinx has been broken with LG, and you remember what had happened with Coal India. So, really, two parts to the question. One, what does the LG IPO tell us about investor interest and sentiment and even supply going forward? And it's quite another bit of element that we saw where the MD spoke in Hindi, and that has gone viral apart from the rise that we saw, the listing gain that we've seen. What does the LG IPO tell us about the state of the Indian market?
So without commenting on specifics, I think very clearly if the IPOs are priced reasonably, and if the companies are promising in terms of their business potential and the future profitability, I think Indian investors are smart, and it is very clearly, demonstrable that a global company, uh, which trades at 5, 6p in their home market, gets such a great response. And one of the companies from the most respected business groups opens almost flat. So I think it clearly demonstrates the maturity and the intelligence of the investee class in India, both institutional as well as retail. In terms of the Hindi, I think it's a great thing. I think hats off to the Korean management for taking the effort and respecting the sentiments of India, and also demonstrating that you are in India for the long term, and wherever you are, I think you have to embrace the local, I would say, culture, the local sentiments, and be connected to the grassroots. And I think, as I said, hats off to them, full respect to them. By giving respect, they have gained a lot of respect.
Sunil, you've always backed or often backed manufacturing, capital goods, that particular part of the market, industrials as multi-year stories. Do you see continued outperformance there or room for outperformance, or do you see the market shifting somewhat to consumption, to BFSI?
I think manufacturing has a lot of potential in India, but typically what happens, markets have started discounting too many things too fast. And I think particularly in the capex oriented capital goods segment, I think we ran far ahead of the valuation. And last 1 year for most of the companies has not been great because when you get yourself priced to perfection, even a small disappointment leads to a sharp correction. Having said that, I think there's huge potential. There's no doubt about it. I think a combination of the focus of Make in India as also export opportunities both look pretty good, particularly for precision and specialized manufacturing. At the same time, I think last 2-3 quarters has not been that great because of these tariff related issues. And we hope and pray that this tariff issue gets resolved very fast. Otherwise, there are some sectors like textiles or jewelry or even precision engineering and manufacturing, which might get impacted significantly. Because this 50% tariff came into being on 27th of August. It's been 2 months. I think we hope and pray that this gets solved fast. Otherwise, on the manufacturing side, on the export side for manufacturing, it might be a little bit of a headwind in the near term. But I think as a sector, we like it. On consumption, I'm very sure that consumption in India will do very well. We have already seen the impact which the GST cut had, on particularly autos and discretionary consumption. And I would say that staples we still don't like, but discretionary consumption is a space where we believe there are strong legs for a long period of time. Obviously, you have to wait for opportunities because valuations do sometimes get out of hand. But I think particularly on the discretionary side of consumption, we are quite optimistic.
Sunil, one of the developments that we have been seeing, and I'm taking forward your question of volatility and uncertainty from overseas impacting our sectors, is on the services side, the IT space. We know what's happened in the IT space, but just in the last couple of days, we have seen things like a massive order for one company, another company, HCL Tech, for example, reporting an AI components to its earnings. So what is your view about the IT sector in the medium to long term beyond H1B and all the visa related issues that seem to have come up?
I think even in IT services, this is a sector where India has global competitiveness. So Indian companies are among the best in the world, and I think that is an advantage. Having said that, I think the growth rates which we are used to seeing from these sectors in the past, I think that is going to be very tough. So some of the largest companies are now guiding for 3 to 5% growth. So the growth outlook itself has come off quite significantly. Obviously, this is a very, I would say, oversold sector. So in the near term, there might be a bounce, and these results which have come up have been slightly better than what people were expecting. But having said that, I think the outlook on growth is only going to be muted. Near term, they will benefit from rupee depreciation also, but that's about it. I think headwinds in terms of H1B issues, it might not be as stringent as we dreaded, but there is definitely going to be some issues there. And with this automation, AI coming in, and also large clients of IT services companies setting up their own global capability centers in India. I think all this means that our view is that the pure IT services companies might underperform. But there is still huge allocation to IT services companies and sectors in India from foreign investors and mutual funds. And I see some movement away from the typical IT services to some specialized IT services companies, some product companies, or even some new age technology companies, whether they are the platform companies or some of of the new age businesses which might ultimately get listed, including the semiconductors and the data centers of the world. So I would say IT in India will change, from the traditional IT services company to maybe some other segments of IT services. The way it has changed in financials, earlier financials used to be only banks. Now financials are NBFCs and mutual funds and asset management companies and exchanges and depositories and so many other things. So I think the same thing might happen in the IT services side also.
Within the metals and mining basket, Sunil, because you have such a well calibrated portfolio, 13% in general industrials, almost 14%, 12% in metals and mining. And we've, of course, been tracking certain stocks on the back of the rise in precious metals. We're also keeping an eye on global news. And, of course, as individual stock specific M&A action also. What are the trends or what are the particular themes that you're exploring within that space?
We are quite optimistic on the metal side. Obviously, in the near term, non-ferrous metals seem to be better placed than ferrous metals. Non-ferrous metal, the base prices have moved up. Steel, the prices are still soft. But I think this sector also has transformed. Companies in the metal sector earlier used to have very, very volatile earnings, to the extent that even the largest of largest companies used to go into a loss. I think the companies last 5, 6 years have transformed themselves. The debt equity ratio is significantly controlled. The operational matrices are significantly better. And most metal companies in India are the lowest cost producers in their respective segments in the world, and therefore they will be the last man standing. And I think to that extent, looking at also the fact that dollar is weakening, we are seeing global metal prices inching up. As also, our view is that with the world becoming a little bit more peaceful, there will be some reconstruction demand also. And therefore, given all this, we are very optimistic on the metal segment. However, we also respect that it's a deep cyclical sector. And normally, we don't go beyond 8-9% allocation in our funds to this sector. But we remain quite optimistic on the sector.
Sunil, I want to come back to that theme and focus on the future. Semiconductors, data centers were two sectors that you mentioned. In terms of any other additional opportunities that investors are likely to see, particularly because the IPO pipeline continues to seem to be pretty robust for the near future?
I think the country is evolving. The first $1 trillion of GDP was contributed by very different companies and sectors. From 1 trillion to 4 trillion, it was contributed again by a very different set of companies and sectors. I think when we move from 4 trillion to 8 trillion, that additional 4 trillion will be contributed by a lot of other new sectors. The same thing has happened in the US. Almost 80% of the rise in the US market is contributed by the new age companies. So I think in India, we also have to be aware of that. And the best way of keeping a track on it is to see our own habits in terms of where we are spending money. So, we are value conscious, but at the same time, we are also forward looking. And the good thing is that some of these new age companies have also started focusing on profits. So, if it's profitable, it comes within our investable horizon. And I think to that extent, some of these platform companies, some of these, payment enablers, as you rightly said, over a period of time, we will have opportunity to invest in some of the AI-based companies or the data center-based companies or the platform companies or even the semiconductor companies, even renewables, I would say, new age companies. So we have to keep our eyes and ears open, keep on doing work. I think this is going to be, sectors where obviously at this point of time there are not too many opportunities, but sectors which will grow much faster than the economy as well as the other sectors.
You know, if I look at your portfolio, Sunil, you're also looking at a lot of domestic stories, and I want to just sort of merge a couple of questions because on one hand, the markets are still a little vulnerable to any kind of global uncertainty, and I wonder if you're factoring that in as well in terms of any buffer for shocks. But on the other hand, domestic action has really been the one that's been driving the story at the moment. So do you see that trend continuing? We've seen an outflow of course, FI money, but DIs have definitely been keeping the market afloat.
So if I break your questions into two parts, obviously, India is predominantly a domestic focused economy. Exports are less than 20% in terms of our contribution to the economy. And to that extent, India will always depend more on domestic growth for its GDP to sustainably move beyond 6.5, 7%. And I think a combination of government offer efforts, the liquidity surge which I mentioned from the central bank, as well as the fact that demographics are in favor of us being such a young economy. I think all that leads us to believe that obviously domestic is going to be very crucial, whether it is consumption or capex or infrastructure building. At the same time, some exports are necessary. The sectors where India has, I would say, large exports are sectors which generate a lot of employment. So whether it is IT or textiles or some other like shoes and jewelry and all, and therefore we should basically not disregard that the settlement to the tariff issue is very, very important. In terms of flows, India did very well from 2014 to 2024 compared to China, compared to emerging markets, compared to almost all countries. And at one point of time, the overweight on India by most funds was almost 3 to 4% compared to the emerging market weight. I think things have reversed dramatically last 1 year. And now we are almost 3-4% underweight in most emerging market fund portfolios, which is the lowest we have gone in the last 10, 12 years. And now the valuations are also not entirely cheap, but not crazily expensive. And I think given all this and given the tailwinds which we have in terms of the growth potential, it's a matter of time before global investors also start to look at India. Already we are seeing selling ebb quite significantly. And even we manage some funds for global investors. I think the interest is reviving last 3-4 weeks. So we are quite optimistic that the year 26 and 27 can be good positive years even in terms of FI flows. And while domestic flows will continue to flow, we meet investors. I think the maturity level for investors have increased. We even talked about it earlier. But investors realize that these one-off years of no return or low returns are transient. If you look at from a 3-4 years perspective, equity has the potential of being the best asset class. Though returns might be maybe low to mid-teens, and I think that is a great maturity. So I think both from a global as well as domestic perspective, we remain quite positive.
Sunil, I have one final point really to take with you before going to Aabha, and this is a broader question about the overall reforms focus of the government. We started this conversation from there, and we know that there are several other things that are in play. How much of that macro can seep into even better sentiment and of course corporate turnarounds, because government spending, for example, continues to remain robust, particularly in the infrastructure space?
I think both the central bank and the government pushing for growth is music to the ears, and pushing at the same time. So you have liquidity and you have the government push in terms of lower taxes and trying to do a lot of things which you mentioned on the infrastructure front. And I think that makes us pretty optimistic that growth is going to come. Obviously, the state level finances and this freebies during state elections worry us. But, being a large country with 1.4 billion people and a lot of poor people, I think we have to accept that a little bit of socialism is also not going to end, and it is needed also. So I think amidst all this, despite all the chaos, our view is that India will continue to grow at 6.5%, 7%, and that would mean that this $4 trillion economy, the first target of doubling it to 8 trillion in the next 7, 8 years, looks pretty much possible. The balance sheet of the government is phenomenal, and I think the biggest boon which India has got is falling crude prices. Crude prices are falling like never before. It's already down to $58 and $61, depending on what crude you use. And I think that can be the biggest benefit which India as an economy can have. This whole surge of renewable is here to stay. And we used to always get impacted as an economy whenever oil prices used to move up significantly. I think we have come significantly beyond that. So the risk premium which the country used to get because of, I would say, very volatile macroeconomic factors is now no more there. And I think that is the reason why currencies tend to be stable. Fiscal deficit is pretty much in control. Forex reserves are at $700 billion. Indians are richer than ever. We have 25,000 tons of gold, which is worth $3.8 trillion. Compared to the $1 trillion we have in equity, I think people are more richer than they ever were because generally people have more as an economy in gold than they have in equity.
And we should count and we should add silver to the mix, considering what's happening there.
All right, Sunil, thank you so much. Always a pleasure and good to hear how optimistic you are on the growth story from all angles, keeping in mind some of the factors that we're still wading through, but maintaining that India has a stable base and we can only move forward from here. Always a pleasure. Thank you so much for joining us.
Thank you so much.
Happy Diwali again.
Happy Diwali.
Markets move today to what's setting the stage for tomorrow. From tariffs to taxes, mutual funds to your daily stock queries. Join me as I decode the biggest wealth-creating ideas for you at the closing bell. Watch me as I bring to you the Business Today show every weekday at 3 p.m. only